Welcome to the Deep Dive, your direct line to the most critical insights in finance. In this dynamic, honestly ever complex world of financial crime, staying ahead isn't just about understanding risks. It's about anticipating how they evolve and, what that means for your work day in, day out. Today, we're taking a deep dive into something absolutely essential for risk managers like you, especially if you're in banking or insurance. It's the European Banking Authority's, the EBA's, fifth opinion on money laundering and terrorist financing risks. This just came out July 2025, and it's packed with insights from right across the EU.
Exactly. And it's important to understand where this comes from. The EBA issues these opinions every 2 years, and they're based on, incredibly comprehensive data. We're talking January 2022 through December 2024 for this one. They pull from 52 competent authorities, their own 𝗰𝗯𝗂𝗧 database, which is huge, and their ongoing supervisory work. The whole point is really twofold. Guide the authorities on their risk-based supervision and feed into the European Commission's bigger supranational risk assessment.
So it's grounded in some serious data gathering.
Oh, absolutely. So our mission today really is to cut through all that detail and pull out the absolute must-know nuggets for you. Think of it as your shortcut to getting genuinely up to speed on the latest threats and trends hitting the EU financial sector right now.
Right. So this deep dive is for you, whether you're prepping for that critical meeting, maybe just trying to catch up on the latest in financial crime, or if you're just really curious about what's next on the horizon for risk management in banking and insurance. Okay, let's unpack this then. The EBA's report. It really paints a vivid picture, doesn't it? A financial sector facing an increasingly complex MLTF risk landscape. It seems pretty clear that fast-moving fintech and the growing interconnection between sectors are creating new weak spots.
That's spot on. And what's fascinating, I think, is how these big trends translate into very specific areas of concern, stuff that every risk manager, especially in banking and insurance, really needs to have on their radar.
Okay, let's start with fintech then. Innovation's great, we all agree on that. Drives growth, expands access, better customer experience. But from a risk management perspective, what's the EBA's sort of main worry here?
Well, the EBA definitely found a significant downside. Get this. A staggering 70%, 70, of competent authorities in the EU are reporting high or increasing MLTF risks just in the fintech sector.
70%, wow.
Yeah. The overriding concern is that this rapid growth just hasn't been matched by robust AML-CFT controls. It seems in many cases, fintech providers have been more focused on grabbing customers than building solid compliance foundations. And this shows up in specific vulnerabilities. For instance, big majorities of authorities flag things like exposure to cybercrimes, especially cyber-enabled fraud. That's a big one.
Right.
Then there are complex internal setups, like relying heavily on outsourced services without really effective oversight. And cross-border transactions, 86% saw that as a very significant risk. But crucially, almost half, 48%, and that's up from 34% in 2023, found customer due diligence CDD measures just inadequate. That is a critical red flag.
Okay, so the takeaway here for risk managers is clear. Jumping into fintech without nailing the AML-CFT basics, particularly around cyber fraud and CDD, is creating real systemic risks.
Precisely. Foundational AML-CFT rigor is key.
And that inadequate CDD, that's a major worry. Does this risk stay sort of walled off within the fintech firms themselves, or are we seeing it spill over into traditional banks and insurers?
Oh, it absolutely spills over. That's a key point. Fintech firms often just don't have that deep-seated expertise or the mature governance structures to handle MLTF risks effectively.
Okay.
So when traditional institutions like banks or insurance companies acquire these firms or partner up, those inherent risks can unfortunately just migrate right into the established sectors. The report also flags white labeling.
Yes, where a firm uses its own brand but offers another institution's licensed products.
Exactly. 90% of authorities see that as medium to high risk. It's complex, often cross-border, and makes oversight really tricky. Similarly, virtual IBANs, they pose risks because you often lose visibility of the actual end user.
Which hinders monitoring.
Exactly. Good news on IBANs, though. The new AML regulation, the AMLR, will require them to be registered from July 2027. That should help boost transparency quite a bit.
Okay, that's helpful. Now, given these challenges in fintech, it makes you think about the tech actually designed to help with compliance, right? So RegTech.
Yeah.
These solutions, they should be a dream for compliance departments, streamlining things, dynamic risk profiles. So what's the catch, according to the EBA?
Yeah, you'd think so, wouldn't you? But the catch is pretty significant. More than half of all the submissions to the EBA's 𝗰𝗯𝗲 database suggested that serious compliance failures were actually due, at least partly, to the improper use of AML-CFT RegTech.
Improper use, not the tech itself, but how it's used.
Exactly. That's a really critical lesson for any risk manager thinking about adopting new tech. It's not just about having the tool. It's how you implement it, how you govern it, how you manage it. The report points to specific hurdles. Things like inadequate in-house expertise to actually understand and run the systems properly, poor governance around the tech, insufficient oversight. For example, 55% of authorities worry about the risks of just outsourcing RegTech solutions without proper checks.
Handing over the keys without knowing how the car works.
Sort of, yeah. And 46% point to significant risks from using automated solutions without adequate safeguards, meaning they aren't properly monitored or calibrated or understood. Plus, over a third, 36%, noted institutions often just lack the internal skills to use these sophisticated tools effectively. They called it unthinking use. And there's also concentration risk. That's where relying too heavily on just one or two big RegTech providers creates its own kind of systemic vulnerability, especially if the solutions aren't really tailored to the institution's specific risks.
Right, a single point of failure, potentially.
Potentially. The report specifically mentions 277 material weaknesses just in 2023-2024 linked directly to RegTech issues. So the real lesson here for risk managers, it's not just about buying the fancy new RegTech. It's about the sophisticated implementation, the governance around it, and crucially, having the in-house expertise to leverage it properly. Otherwise, you might just be adding a new layer of risk without realizing it.
That makes perfect sense. And speaking of cutting-edge tech, how is artificial intelligence, AI, playing into all this, both on the compliance side and, I guess, for the criminals? What does the report say there?
Yeah, AI is definitely the next frontier here. While it offers huge potential for compliance, better detection, analytics, you name it, the criminals are already using it very effectively.
Oh, so?
They're leveraging it to automate financial schemes, to hide the source of funds better, generate incredibly realistic fake documents, and using deepfake technologies to get around customer due diligence measures, particularly remote onboarding.
Deepfakes for CDD evasion.
Exactly. And financial institutions are really struggling to detect these increasingly sophisticated AI-driven attacks. They're growing in sheer volume and speed. It means we need not just advanced counter technologies, but also really specialized human expertise within our institutions to even stand a chance against this threat.
Okay. Let's switch gears slightly. Crypto assets, always a hot topic, new regulations coming online. What's the EBA's latest take on the MLTF risks here?
Yeah.
Especially for banks and insurers who might interact with crypto assets or the service providers, the CASPs.
Well, the abuse of crypto asset services for financial crime, that definitely remains a key concern for the EBA. The sheer growth is significant. The number of authorized crypto asset service providers, CASPs in the EU, it multiplied by 2.5 times between 2022 and 2024, over 2,500 now.
Huge growth.
Massive. Yet the competent authorities frequently found that these CASPs often lacked effective AML-CFT systems and controls. They just haven't matured quickly enough on the compliance front. And the most significant risk, identified by 53% of CAs, was a basic lack of understanding of the MLTF risks associated with their individual business relationships in the crypto space.
So not really grasping their own risk exposure.
Pretty much. Concerns were also raised about the integrity of senior management in some cases, and the transparency, or lack thereof, of their governance arrangements. The EBA explicitly calls this out as a gap between regulatory expectations, legal obligations, and actual practice.
So more work needed there.
Definitely. They stress that better supervisory coordination and consistent application of the new EU crypto framework, like MiCA, are absolutely essential to tackle these persistent challenges, especially for traditional financial institutions interacting with the sector.
Right. The report also really emphasizes the alarming rise in fraud. It seems criminals are just getting more and more sophisticated.
They absolutely are. Payment fraud is now flagged as the most significant issue for EU consumers, and Europol actually identifies fraud as the single fastest expanding sector in organized crime right now.
Fastest expanding, that's worrying.
It is. The scale, the variety, the sophistication. It's unprecedented. And criminals are now using AI not just for deepfakes, but to create highly realistic scam narratives, ways to bypass even strong customer authentication. Remote onboarding is a particular weak spot. Criminal networks are exploiting generative AI, including those deepfakes we mentioned, to get past standard ID checks. It makes telling who's real incredibly difficult.
So fake identities getting through the net.
Yes. And this has led to what the EBA calls a very high intensity of effort by criminals to open or just use payment accounts to launder the proceeds of these scams. The numbers are pretty stark. EUR 4.3 billion lost to payment fraud in 2022 alone. Another EUR 2.0 billion in just the first half of 2023.
Huge sums.
Enormous. And credit institutions, investment firms, fund managers, they are particularly vulnerable. Cybercrime, using advanced fraud techniques, phishing, malware, ransomware, it's rampant across these sectors.
Okay, another area that's become incredibly complex, sanctions compliance,
Right.
especially with all the new restrictive measures being added constantly.
Yeah.
What's the EBA seeing there?
Yeah, it's a real challenge. A quarter of the competent authorities noted an increase in the risk of non-compliance just since 2023. And it's mainly down to the sheer number and the complexity of the EU sanctions packages.
Just keeping up is hard.
Exactly. And standard screening tools often aren't enough anymore, especially for the sectoral restrictive measures. A simple name match doesn't cut it. You need to understand the business context, the sector involved. There are specific challenges, too. Like screening SEPA instant credit transfers, that 10-second processing window makes thorough checks almost impossible.
Right, speed versus security.
Precisely. Also, fragmented information access within card payment systems can lead to accidental breaches. The report notes many institutions still lack adequate comprehensive policies and procedures to navigate all this complexity.
So what's the solution there?
Well, the good news for risk managers is that the EBA published new guidelines back in November 2024. They become applicable at the end of 2025, setting common EU standards for sanctions compliance. Integrating those guidelines into your frameworks is absolutely key. That's a major development to track.
Okay, that was a lot to take in. Quite a few serious challenges highlighted. But it can't be all bad news, surely. Are there any areas where the EBA actually sees positive developments or where things seem to be moving in the right direction?
Yes, thankfully there are some positive trends, and they seem to reflect the concerted action by regulators, supervisors, and the institutions themselves. For example, risks related to tax crime seem to be decreasing. And significantly, the issue of unwarranted de-risking also appears to be lessening overall. A remarkable 80%, 70, of competent authorities now indicate that de-risking is either declining or actually no longer a major issue in their country.
80%. That is a substantial improvement.
It really is. It shows that focused guidance and supervisory pressure can actually shift behavior on complex issues like that. We've also seen increased supervisory engagement across the board. And this seems to be leading to improved residual risk levels. That's the risk left after controls are applied, particularly in credit institutions, credit providers, the three big financial market sectors.
Investment firms, collective investments, fund managers.
That's right, and life insurance, too. So better control effectiveness in those areas. And here's something genuinely surprising from the report, a real shift. For the first time, risks associated with products and services are actually outpacing risks related to firms' customers.
Really? So the risk profile is changing?
It seems so. It's a notable shift. It suggests that maybe the inherent risks in complex products or delivery channels are becoming more prominent compared to just the risk profile of the customer base. That definitely demands a reevaluation of how risk is assessed within your institution.
Okay, so that sounds like real progress in some areas and a fascinating shift in the risk profile. But are there still those foundational weaknesses, things that persist across the sector that risk managers absolutely still need to be vigilant about?
Oh, absolutely. Despite that rise in product and service risks, the report is emphatic. 61%, over 60% of all breaches across all sectors are still caused by customer due diligence failures, CDD shortcomings.
Still CDD. After all this focus over the years.
Still CDD. It remains this pervasive critical weakness. It suggests that while we're getting better at tackling maybe newer threats, some fundamental blocking and tackling is still being missed. The report details common CDD issues. Credit institutions, for example, often have the policies on paper, but they fail to apply them effectively in practice. That leads to failures in customer risk ratings. E-money institutions, bureau de change, credit providers, they showed failures in basic customer identification.
Just getting the idea right.
Yeah. While customer verification was weaker in credit and payment institutions, and for our listeners in life insurance specifically, there were notable issues around identifying politically exposed persons, PEPs.
Okay, so CDD remains job number one, essentially. What else?
Well, beyond CDD, failures in the wider AML-CFT systems and controls are the second most common issue. This is particularly prevalent in payment institutions, e-money institutions, and those crypto asset service providers we talked about. And here's a critical point for them. In those sectors, the residual risk levels actually exceed the inherent risks.
Meaning their controls are making things worse, which is not effective at all.
It signals their controls are simply insufficient to mitigate the high inherent risks they're dealing with. They're not bringing the risk down adequately. Terrorist financing TF risk also remains under-addressed, according to the EBA. Many institutions seem to over-rely on basic sanction screening as their only TF monitoring tool. They lack a robust methodology for actually assessing TF risks specific to their business. The report flagged 62 material weaknesses just related to TF risk between 2022 and 2024.
62. And PPs. You mentioned life insurance, but is it broader?
Yes, material weaknesses related to PPs continue more broadly, too. 203 instances were reported in that same period, particularly hitting the investment firm sector hard. And the report notes a rising trend, using cryptocurrencies and FinTech platforms to transfer bribes or manage illicit PEP funds.
So, new methods for old problems.
Exactly. And finally, an area that's relatively unaddressed but likely to grow in importance: environmental crimes. 2/3 of member states haven't even properly assessed this risk yet, even though things like waste trafficking pose a significant risk for 1/3 of competent authorities already, and illegal resource extraction is also a growing concern. That's a space to watch.
Definitely an emerging risk area. So it sounds like the supervisors have their work cut out for them.
Yeah.
What does the EBA report tell us about their trends? How are they actually approaching supervision now? Is it changing?
It is changing, yes. The report highlights a really significant and consistent increase in off-site reviews. They were up 41% between 2022 and 2024.
41% increase in off-site.
Yes. It strongly suggests a growing emphasis on remote supervision, using technology, requesting data, analyzing it remotely to monitor compliance. While those off-site reviews are way up, on-site inspections have remained relatively stable. They seem more focused now on higher risk sectors or specific high risk activities.
So what does that mean practically for a risk manager listening now?
It means you can likely expect more data requests, more remote interactions with your supervisor, more desk-based reviews. But alongside that, you should also be prepared for targeted, potentially unannounced on-site checks if you're deemed higher risk. The nature of the scrutiny is definitely evolving.
Okay. This has been incredibly insightful, a really comprehensive look at the EBA's findings. So for you, the risk manager in banking or insurance listening to this, what are the absolute key takeaways? If you had to boil it down, what should you be thinking about right now, and what actions should perhaps be prioritized?
Right. I think this report isn't just, a list of risks. It's really a clear roadmap for reinforcing your AML-CFT frameworks and making sure you're adapting to this rapidly changing environment. I'd highlight 4 key things. First, proactive and prudent technology adoption. Don't just rush to implement the latest FinTech and RegTech solutions. The report makes it clear you must ensure you have the necessary in-house expertise, the robust governance around it, and rigorous testing protocols in place. Avoid that unthinking use trap. This definitely includes understanding both the risks and the opportunities of AI. Not just defending against those sophisticated attacks we discussed, but also thinking about responsible deployment within your own systems, always backed up by strong governance and really comprehensive staff training.
So smart adoption, not just adoption for adoption's sake.
Exactly. Second, maintain a relentless focus on enhanced due diligence. Yes, product risks are rising, but CDD is still where most breaches happen. You need to revisit your ongoing monitoring processes with fresh eyes. Ensure you actually have visibility into the true identity of end users in complex setups like white labeling or VIBANs, and actively work to counter those new bypass techniques like the AI deepfakes and remote onboarding. This is fundamental, it's persistent, and it demands immediate ongoing attention.
Okay, CDD remains paramount. What's third?
Third, cultivate a holistic and dynamic risk assessment approach. Your business-wide risk assessment can't be static. It needs to be comprehensive and constantly evolving. Make sure it effectively distinguishes and addresses not just money laundering, but also terrorist financing specifically, the real complexities of sanctions compliance, especially sectoral ones, and instant payments, and those emerging areas like environmental crime, which many are still overlooking. And that EBA finding about products and services outpacing customer risk, that should definitely prompt you to reevaluate your internal models. How are you weighting different risk factors? Does it still reflect reality?
Good point. Dynamic assessment. And the fourth takeaway.
Fourth, and finally, embrace adaptability and collaboration. The threat landscape is changing constantly, driven by tech, driven by criminal innovation. You have to stay rigorously informed, read the regulatory guidance, engage proactively with your competent authorities. Don't wait for them to call you. And ensure your internal controls are flexible enough to adapt quickly when new threats emerge. Learn from these supervisory trends. The EBA highlights the increased off-site reviews, the targeted inspections, and make sure your firm is prepared for that evolving scrutiny. Continuous learning and adaptation are absolutely crucial for staying ahead, or at least keeping pace.
That was quite the deep dive indeed into the EBA's fifth opinion on MLTF risks. It's crystal clear the landscape for risk managers in banking and insurance isn't getting any simpler. But understanding these nuances, these specific shifts and vulnerabilities, that really is your biggest advantage in protecting your institutions.
Indeed it is. And the report really underscores the need for continued regulatory clarity, yes, but crucially also a much more consistent application of these risk-based approaches right across the EU financial sector. It truly is a journey, as they say, not a destination.
And that leaves us all with perhaps a provocative thought to mull over as we wrap up. As the digital frontier of finance continues its relentless expansion, will the ingenuity and adaptability of compliance professionals actually be able to consistently outpace the evolving sophistication of financial criminals? Or are we perhaps destined to forever be playing catch-up in this incredibly complex, high-stakes game of cat and mouse?
Something definitely worth considering as you navigate all the challenges ahead.
Thanks for joining us for this deep dive.